Welcome to The Explainer. Today we're unpacking the 2026 Advisor's Playbook for navigating the markets. We're getting a lot of mixed economic signals for 2026, so our main goal today is to decode what it all means and figure out exactly how we can adjust your portfolio strategy to really thrive.
So here is the crucial question right out of the gate. Is your portfolio prepared for the shifting winds of 2026? It's a serious question that requires a serious answer. Look, after a phenomenal run for certain asset classes over the last few years, there is a very real danger right now of remaining offsides. What does that mean? It means sitting on an over-concentrated, backward-looking portfolio while the broader market dynamics are fundamentally changing right beneath our feet. We definitely don't want that.
To make sure we're fully prepared, here's our quick itinerary for today. First, we'll weigh structural growth against cyclical risks. Next, we'll look at agile fixed income strategies. Third, we tackle the big question: AI equities, bubble or boom? Then, we'll explore the international equity opportunity, and finally, diversifying the concentrated portfolio.
Okay, let's dive into Section 1. Structural growth versus cyclical risks, the K-shaped economy.
Right now, there's a massive tug-of-war happening in the macro environment. On one side, we've got this structural lift. This is the hot stuff lifting the market. Think massive AI investment by the tech giants, upcoming tax refunds giving the first half of the year a boost, and those huge wealth gains from the ongoing stock market boom. But on the flip side is the cyclical drag. This is the cold reality of higher tariffs, lower immigration straining the labor supply, and sluggish, rate-sensitive sectors like housing. Essentially, we're looking at a K-shaped expansion. Wealthier households are spending those stock market gains and driving the top of the K upwards, while middle and lower income consumers are really feeling the pressure of inflation and borrowing costs on that downward slope.
It's almost like AI investment is acting as the absolute powerhouse of the economy right now, literally carrying the weight of the world on its metal shoulders. But let's be real, those burdens are incredibly heavy. Tariffs, soggy growth, high valuations, debt, and inflation. It's a massive lift, even for a supercomputer. While structural growth is absolutely strong, those cyclical economic risks are very, very real. We can't just blindly ride the AI wave without preparing your portfolio for those cyclical drags.
Moving on to Section 2. Agile fixed income strategies, navigating a divided Fed.
Because of these mixed economic signals we just talked about, the Federal Reserve is deeply divided right now. Some members are worried inflation is going to stick around because of tariffs, while others are hyper-focused on unemployment risks. So our playbook for bonds has to be super agile. Step 1, expect rate volatility. We need to shift away from trying to perfectly time rate cuts and just expect a much bumpier ride. Step 2, manage duration nimbly. Duration is basically just how sensitive your bonds are to interest rate changes. With short rates hovering around 3.5 to 3.75% and long rates settling higher, we have to balance short-dated securities with select intermediate maturities to adapt. And Step 3, lock in high-quality income.
That brings us to our crucial strategy right now. Literally lean into the income in fixed income. Instead of betting entirely on interest rates dropping to generate capital returns, which, let's face it, is a gamble right now, our strategy is to focus on locking in actual, reliable income. We're looking at solid corporate and municipal balance sheets. History shows us that when inflation is a concern, the Fed treads very carefully. We really need to focus on disciplined risk control and let the income generation do the heavy lifting for this part of your portfolio.
All right, Section 3. AI equities, bubble or boom, analyzing tech valuations.
So a lot of investors have very valid fears that these sky-high tech valuations mirror the early 2000s dot-com bubble. But consider this critical insight from the research. Bubbles burst into nothing, but the AI theme is building real infrastructure to meet growing demand. I love that quote because it highlights a fundamental difference. This AI boom is backed by actual, monetized demand for cloud services, hardware, and software. It isn't just speculative excess, it's the tumultuous beginning of a massive structural transition. To really drive that point home, let's ground this narrative in the data. 20%. That is the tech sector's current free cash flow margin. That's the actual cash left over after all operating expenses and capital investments. Guys, that is more than double the level we saw in the late 1990s. This metric proves these companies have the fundamental financial strength and profitability to self-fund this massive AI investment cycle. They are highly profitable, cash-rich firms. That makes this current environment look a lot less like a house of cards and much more like a well-funded, sustainable boom.
And we're seeing massive venture capital flowing not just into early AI semiconductors, but expanding aggressively into large language models and sector-specific applications. The AI opportunity is broadening out so rapidly into private markets. The beneficiaries are shifting from just the early innovators to the enablers, like industrials and utilities providing the power, and the adopters in finance and healthcare. This is exactly where we need to stay actively engaged so we can capture the evolving winners.
Let's turn to Section 4, the international equity opportunity, narrowing the exceptionalism gap. For the last decade or so, U.S. markets have been exceptional, vastly outperforming the rest of the world. But here's the thing, that earnings growth gap is narrowing, and global reallocation is a recurring tailwind we absolutely want to capture. We're seeing positive nominal growth, meaning growth before adjusting for inflation, transforming European and Japanese banks. Plus, that AI theme we just discussed, it's heavily broadening out into Asia, particularly in tech sectors across Korea, Taiwan, and Japan. Then there's global fiscal spending. European countries are pledging to spend 5% of their GDP on defense and infrastructure. And crucially, shareholder-friendly policies are spreading globally. We're seeing a massive surge in share buybacks in Japan and Korea that's starting to rival the US. There is real, fundamental, structural growth happening outside our borders right now, and we shouldn't ignore it.
Finally, Section 5. Diversifying the concentrated portfolio. Getting back on sides.
As we established earlier, there's a huge danger in being off sides right now, meaning your portfolio is overly concentrated in U.S. large-cap growth, and you're missing out on those broadening asset class returns. If this K-shaped economy gets bumpy, we need defense. But traditional safe havens are kind of flipping on their heads. Gold, historically a top safe haven, has actually been struggling with high real yields and an inflationary supply shock. Instead, true safety is being found in currencies with deep institutional credibility. The Swiss franc offers proven neutrality and stability in Europe, and the Singapore dollar is proving incredibly resilient in Asia. The very nature of what makes an asset safe is changing depending on the type of economic shock we're facing.
To further protect your portfolio, we should look at high-grade defensive stocks on the ASX, that's the Australian Securities Exchange. We're talking about resilient companies like Transurban at a 4.6% yield, Telstra at 4.1%, and Wesfarmers at 2.7%. These are large, reliable businesses operating in non-discretionary sectors like toll roads, telecommunications, and essential retail. They provide reliable, consistent cash flows and passive income even when consumer confidence wanes and market volatility spikes. Adding this kind of stable, defensive equity is just a fantastic way to ward off the cyclical instability we might see in 2026. As we wrap up this explainer, I want to leave you with one final provocative thought. In a year where diversification is different, not dead, are you ready to get your portfolio back on sides? The markets of 2026 are full of both incredible structural booms and heavy cyclical risks. You simply cannot rely on last year's playbook. It's time to take action, rebalance your wealth, and ensure you're perfectly positioned for the realities of the year ahead. Thanks so much for learning with me today.